Welcome, everybody, to our continuing series of webinars on option trading strategies. And today we're going to cover option spread strategies. The spread strategies in general seem to be the best type of strategy to use in the type of markets that we've had the last several years. And I'm just going to show you real quickly some snapshots of the S&P 500 index over the last several years. And what all these price charts have in common is a lot of price swings, a lot of volatility, but no clear trend. So it's difficult to profit in these types of markets if you're a directional trader. If you just buy a stock, or you buy a call option, or you buy a put option, sometimes it's hard when the market's not trending and you get a lot of these volatile price swings to be profitable. So I've been focusing more and more the last several years on these spread strategies, and they work very well in this type of market environment. And in today's webinar, I'm going to show you some real-time results demonstrating how well these strategies have been doing. And here's some interesting stats here to start off with this U.S. S&P 500 index. This is a snapshot, and again, you can see of the S&P 500 index, and again, you can see a lot of price volatility here, no clear trend, and that's been very typical the last several years. And last year we had 68 days during which the S&P closed either up or down more than 2%. So I mean that's a lot of price volatility. And the S&P last year actually finished unchanged for the year. It opened the year in 2011 at 1257 and closed the year at 1257. So, it was definitely no trend last year, and yet we had 68 days where the index either closed up or down more than 2%. So a lot of volatility, not much trending in these markets. And these are very untypical compared to, I don't know if you've ever traded in 1980s and 1990s bull markets, but you'd have a trend that would last for months or years, and it was pretty easy to make money back in those days. But those days are gone, and right now we're faced with for the most part, non-trending markets, a lot of price volatility, very difficult to trade if you're a directional trader. So that's why we've been focusing more and more on these spread strategies. And here's another snapshot. This was in 2010, and over this time frame here, the S&P, you can see again a lot of price swings, but the S&P only moved 2 points over this time frame. Here's another snapshot. This was last fall. Again, a lot of price volatility. And the index itself was virtually unchanged. And as I mentioned, last year, 2011, the S&P started at 1257, closed at 1257. And here's a snapshot, another snapshot, and this is a more recent one. This is from July of 2012 to July of 2011. So over the past year, again, you can see a lot of price volatility here, but again, the market, the S&P index is virtually unchanged from where it was a year ago in July. So that's why we shift our focus in these types of markets to the spread strategies, and these spread strategies can work well in any type of market. So we're going to look at the covered call spreads, the super portfolio spreads, option spreads, and market neutral spreads. And these have all been performing well in this type of market environment. And for those of you who have attended some of my previous webinars, I covered some of these strategies in previous webinars. So what I'm going to do today is kind of just update you on the strategy. I won't go into as many details as I did when I first introduced these strategies, but today I'm going to try to just kind of update these strategies for those of you who have attended previous webinars. So the overall goal of these spread strategies is to profit in up, down, or sideways markets. And another goal is to increase the profit potential of a directional stock or option trade. So if I take a stock trade or I take an option trade and I have a profit in that trade, in this type of market environment, I'll go ahead and sell a call option against my long stock, or I'll sell a call option against my long call to create a spread. And that way, it increases the existing profit potential of that directional trade. And of course, the short call will also provide downside protection. And because the short call, of course, profits if the underlying stock or ETF moves down in price. So you got that downside protection built in. And a really important characteristic or advantage of these spreads is they help you maintain your position during volatile markets and wide price swings. And they help you avoid being stopped out of your position. When I trade stocks or options, I always like to use money management rules to exit the stock or exit the option trade if it moves against me from my entry price. You have to do that to cut your losses short. And but with these kind of markets, you get stopped out a lot with these directional trades. So if you create a spread, then you can hang in there, and it can help you avoid being stopped out of your position, whether it's a stock or option position. So let's talk about the first spread strategy, what I call the super portfolio, and this has been performing great in this kind of market environment. So far this year, we have about a 55% return on this strategy. And with the super portfolio, we buy stocks or ETFs that are performing well despite Europe and all the problems over there and the slow-growing U.S. economy. And then what we do is we purchase these stocks, then we sell weekly call options on weaker sectors against our super portfolio stocks. And I'll show you an example of that here in a minute. And this spread strategy allows you to profit from the best performing stocks and at the same time profit from selling weekly calls in market sectors that are weak, such as Brazil or China or energy ETFs. So you can profit on both sides of this spread, and I'll show you some examples of how that works here in a minute too. Now, the super portfolio spread is not a covered call because you're selling a naked option and you don't own the underlying ETF or stock that you're selling a call. So this is a little different than covered calls. It's a higher risk, so it requires a higher level of approval in your trading account. But having said that, one of the advantages of this spread strategy compared to covered calls is that it doesn't place a limit on the profit potential of that stock, of that super portfolio stock. If you write a covered call, then your profit potential's capped, and if the underlying stock moves up in price, once it gets above the strike price of the short call, then your profit is capped at that point. However, with the super portfolio, you don't place a cap on that underlying stock that you own, that super portfolio stock. So, for example, I have a 41% profit right now in super portfolio stock TJ Maxx, symbol TJX. And I have a 41% profit, but at the same time I've been profiting from selling option premium against this super portfolio stock on the Europe, China, and energy ETFs. So I've been profiting from both sides on this spread. And again, with the super portfolio spread, your upside potential is not capped. So when you sell, let's say, the China ETF against TJX, it doesn't cap the premium. If TJX moves up in price, it's not going to cap that profit. So again, these super portfolio spreads have been working real well in this current market environment. And typically, these super portfolio stocks, they're in a confirmed price uptrend using our Prime Trade Select trade selection process. They typically have little or no correlation to European economies or debt problems. They're not dependent on the price of oil or commodities, and they have strong growth rates despite the slow-growing U.S. economy. So these stocks have been performing well in general this year, despite all the problems we have in the world economies and in the U.S. economy. So these are leading companies that are doing well regardless. Here's a snapshot of TJX. This is a daily price movement, and it's in a confirmed price uptrend using our Prime Trade Select trade selection process. We can see that the 50-day EMA line, which is this blue line, is above the 100-day. So we're in a price uptrend, and this price uptrend is confirmed by TJX making a series of new 52-week highs, and we also have an upsloping on-balance volume line, which also confirms this price uptrend. So TJX is in a confirmed price uptrend. It has little or no correlation to the European debt crisis. It's not dependent on the price of oil or commodities, and TJX has strong equity and retained earnings growth rates in a slow-growing U.S. economy, and it's in a leading industry, retail. So this is a typical super portfolio stock. And here's
Chuck, not to interrupt you real quick, Chuck, but are those 5 points on that prior screen, are those the parameters that you would consider for all super portfolio stocks? And if it doesn't meet one of the criteria, do you just pass it by?
Yes, this is typical of most of the super portfolio stocks. Now, there may be one criteria that it doesn't meet, but I won't eliminate a stock if it doesn't meet one of these criteria. But most of them have this criteria in common, but I wouldn't necessarily eliminate a stock if one of these didn't line up. So to answer your question, in our trade selection, we take these all into account, but I wouldn't let any one of these criteria prevent me from investing in a good stock. So here's a snapshot of my open trade profits for TJX, and I've got over $67,000 in open trade profits. And while I own TJX stock, again, I've been selling call options against that. So my profits for the super portfolio spread are actually greater than what I'm showing here for the open trade profits for the stock. And here's a typical ETF that I've been selling calls with. This is the Brazil ETF, symbol EWZ. And we can see EWZs in a confirmed downtrend with the 50-day EMA below the 100-day, and we have a downsloping unbalanced volume line in EWZs making a series of new 52-week lows. So the idea here is to profit not only from the super portfolio stock, which is far outperforming the general market, but at the same time, we can also profit from being short these ETFs in the weaker sectors. Here's an example of some calls I sold, EWZ calls, and I collected $1,909 in cash income from selling these calls, and these were weekly options. And selling the weekly option calls has a lot of advantages over selling monthly calls, and we'll go into some of those advantages here in a minute. But basically, with the weekly calls, you can sell ETF calls 52 weeks a year. So that's a lot of option premium over the course of a year. So I sold 19.41 points of option premium with the sale of the 21 EWZ call options, and again, this resulted in $1,909 in cash being credited to my brokerage account after commissions. Now, this is for a weekly option, so I collected $1,900 in cash just for that 1 week option. So when I sell a call like that and collect that $1,900 in cash, that reduces the cost basis of the TJX stock, and it reduces the overall risk of the trade. Again, with these weekly calls, you get to sell them 52 times a year, so that's a lot of premium. So what I like to do is I like to compound my returns, and I reinvest that premium I collect every week. I'll invest that in additional spread trades, super portfolio spread trades, and that allows you to compound your returns.
Chuck, can you possibly just comment on basically with your returns on holding your positions through options expiration?
Yes, that's a good question. And what I typically do, Tom, with these when I'm selling this weekly option premium is I simply hold if it's a super portfolio spread, I just simply hold the stock in the portfolio, and on Thursday or Friday, I'll roll over the short call that I have to the next week's call, and I use a option spread order to do that, and I'll show you an example of that here in a minute. But basically, I hold the stock in the account and then roll over these weekly calls every Thursday or Friday. And if it's a covered call, I'll hold the stock in the account, and again, same idea. I'll roll over those weekly options if it's a covered call trade, and I'll show you an example of that too here in a few minutes. So now, if you're short an option, the time value portion of that option becomes profit at option expiration. Just option basics are options consist of time value and intrinsic value, and at the money calls or out of the money calls consist of only time value. So options lose all time value at expiration. So if you're short an option, whatever time value that option had becomes profit at expiration because the time value decays to zero at expiration. So that time portion of the option, time premium portion, becomes profit at option expiration. And in the case of these weekly options, you're only holding them for a week, so the time value portion of that weekly option becomes profit 1 week later. And here's an example of the EWZ ETF. And in this example, my brokerage transaction history shows that I sold 13 of these 57 strike calls at 105, and EWZ was trading at 56.95. So this was an at-the-money call. So this time premium, this 105, is all time premium because it's an at-the-money call, and the strike price was higher than the price of the ETF. So again, at-the-money options consist of only time value, and that time value becomes profit at option expiration. So I sold these 13 calls for 105, collected 1347 in option premium, and that by the way is cash that's immediately credited to your brokerage account when you sell this option. So that $1,347 in cash was credited to my brokerage account, and that becomes profit at 1 week later at option expiration. So with the super portfolio spreads, I like to sell the call options and have an equivalent amount of stock in my account for the spread. So in other words, if I sell the 57 strike EWZ call, that 57 strike call has an underlying value of about $74,000. So if I sell 13 of them, that'll cover about $74,000 in super portfolio stock. So by selling those 13 57 strike calls, that's the equivalent of about $74,000 in stock. So I try to match up the selling of the calls with the underlying stock, and I like to sell an equivalent dollar amount. So let's say that I was able to collect a similar time premium each week selling these call options. So we'll take that $1,347 that I collected, and if you multiply that by 52, I have the potential to collect over $70,000 in time premium over the course of a year. And if I divide that $70,000 by the amount of stock it covered, roughly $74,000, you can see I'm going to get a cash-on-cash return from selling that premium of about 94% over the course of a year. So these weekly options really allow you to collect a lot of premium, and it really adds up over a year. And in this example of the EWZ 57 strike call that I sold, if I sold a similar premium each week, I'm going to collect 94% cash on cash over the course of a year. So even if the TJX stock declines 20%, I still have the potential to realize a good return on this spread because I'm collecting this 94% cash on cash return. And as I mentioned before, I like to roll over these weekly options. So that $70,000 I collect in premium, if I invest in more spreads, that can really allow you to compound your returns quickly. And here's some more examples. Now, when I sold the EWZ call options, I sold the 57 strike, and the EWZ traded below 57, and it was declining pretty rapidly. So what I did is I bought back those short calls, and I sold additional calls all within the course of a week, which allowed me to actually collect 2 option premiums in 1 week. So I collected a total of $2,877 because I collected the $1,909, bought back those 21 calls. That cost me $292 to buy them back, and then I sold an additional $1,261 in premium. So over the course of a week, I was able to sell $2,800 in premium. And then, actually that week, I bought back those calls a second time, and I actually sold 3 premiums that week. So I was able to triple dip that week when the index was very weak. And for smaller accounts with the super portfolio, like I say, I like to, when I sell a call option, I like to sell that against an equivalent amount of stock. So let's say you sold the FXI, which is the China ETF. Let's say you sold one of those 35 strike calls. Well, to create the super portfolio spread, you'd purchase roughly $3,500 in super portfolio stocks, and you could also divide that $3,500 up, and you could actually buy 2 super portfolio stocks if you invested $1,750 in each one. So with the smaller accounts, you could sell, say, a 35 strike call and have $3,500 of super portfolio stocks. And you do need a margin account to trade these naked options. So that's one thing to keep in mind. And Tom, I believe margin account requires a $10,000 account.
That is correct.
Okay.
And that's not a firm rule, that's a regulatory rule.
Okay.
The reason being is obviously if you get exercise, and if you're naked, they're going to ask you to have that cash on hand. So you are correct with that.
Yeah. Okay. So, and here's, I took a snapshot. These were closed trade profits after commissions for these short ETF calls. And this week I collected over $24,000 in closed trade profits after commissions. And in this particular week, even though the markets were very weak, the global markets are very weak, and I was able to double and triple dip on these, selling these short calls, the super portfolio stocks over that same time period actually had a positive return. So the super portfolio stocks were up even during this very weak time when the global markets were selling off, and I was buying back my calls and then selling additional calls and then buying them back and selling 3 premiums inside of 1 week. Over that same time period, the super portfolio stocks actually had a positive return. And here's a snapshot I took. This, I think, was yesterday or the day before. And this is I have my super portfolio stock in two portfolios, and I currently have, or in two trading accounts, and I currently have $322,000 in open trade profits in these 2 accounts, and these are my super portfolio trading accounts. So currently have $322,000 in actual profits. And here's a snapshot of the super portfolio open trade results as of yesterday for my weekly option advisory, and we have $43,000 in open trade profits, and so far this year we have about a 55% return in the super portfolio. Now this is really interesting. What I did over the last several months is I took snapshots the super portfolio, and then I also at the same time took a snapshot of some of these global ETFs. And on this particular day, this was May 24th, you can see these global ETFs. This is emerging markets. This is the materials ETF. This is Europe, Far East, Africa, energy ETF, Brazil, small cap, and China. On this particular day, these ETFs were down 0.2%, down 3% for the year, and at the same time, that day the super portfolio stocks were up 1.4%, and for the year they were up 31%. So it just shows you the outperformance of the super portfolio versus these global markets. And now every day is not like this. Sometimes these indexes will get pretty oversold, and they'll snap back, and there will be days where the indexes have a higher return than the super portfolio stock, but normally you can see the super portfolio stock will outperform these indexes.
Chuck, not to interrupt you, I know we're getting a lot of questions of people asking how Chuck comes in and selects his super portfolio. Again, at the end of the webinar, if you'd like to go to mytrademonster.com, Chuck did a two-part series back in September showing his stock selection process. By all means, Chuck has allowed us to keep that up there on our webinar, so you can go back and review that. Just want to give everyone a heads up on that. Sorry about that, Chuck.
Yeah, no problem. Yeah, I go into detail on the trade selection process in some of the previous webinars, so take a look at those if you want to get the details on the trade selection process. And here's another snapshot. The index is down 0.2% for the day. Super portfolio up 1.28%. And here's a more recent one. This was July 5th, and you can see the index is down 0.84%. At the same time, the super portfolio is up 0.9% that day, and it was up 37% for the year, whereas the indexes were actually down for the year. And here's another interesting one. This was a couple weeks ago when they came out with the employment numbers on Friday, July 6th. And they were disappointing numbers. And when I took this snapshot, the Dow was down about 150, the S&P was down 18, NASDAQ down 50 in response to the poor unemployment numbers. And you can see, even though these global ETFs were down 1.9%, the super portfolio that day was actually positive, even though we had this big sell-off in global markets in response to the poor unemployment figures. So, again, this is another example of how these super portfolio stocks can outperform. So, now let's take a look at the market neutral strategy. And basically with the market neutral strategy, what we do is we write weekly covered calls on both bullish and bearish ETFs for the same index, which can allow you to profit if the market goes up or down. So, for example, you could buy or you could write a covered call on the bullish small cap index and at the same time write a covered call on the bearish small cap index. So the idea is to be on both sides of the market, and you can profit if the market goes up or down. And now these are covered calls, so this is different than the super portfolio. These are actually covered calls, and these can be traded in most retirement accounts. This is less risk because you actually own the underlying stock or ETF, when you're selling the call option, you actually own the underlying ETF. So these are covered calls and incur less risk than the super portfolio. And then if you write these covered calls on using weekly options, then again you get that opportunity to sell premium 52 times a year. So the premium you collect on these covered calls can be substantial. And I roll over the weekly options each week, like I do with the super portfolio on Thursday or Friday. I'll close out the option that's expiring, and then I'll send the next weekly call option. So today you'd be closing out the July 21st calls, and you'd be selling the July 27th weekly call to roll over this week. Now, with these market neutral spreads, I'm collecting 2 to 4% or more in option time premium per week for both the bullish and the bearish covered calls. And as we mentioned previously, that time premium, that 2 or 4% that I collect, becomes profit at option expiration regardless of the price movement of the underlying ETF. So that's the main reason this strategy does so well is you're selling time premium, and you profit from that at option expiration regardless of the price movement of the underlying ETF. And I write these covered calls on leveraged ETFs, and with a leveraged ETF, of course, the premium's higher. So writing these covered calls on leveraged ETFs can lead to a 200% cash-on-cash return over the period of a year, regardless of the price movement of the underlying ETF. And here's an example. This is the TZA. This is the short small cap ETF, and I sold the 21 strike call at 115. Now that worked out to be a 5.4% weekly premium. So if you did that every week, you're talking over 200% cash-on-cash return over the course of a year. Of course, these leveraged ETFs are more volatile, but you can collect a lot of time premium with these. And even if the underlying index goes against you, collecting this cash-on-cash return, you can still be profitable, even if the underlying ETF moves against you substantially. So here's an example. The TZA was trading at 21.84. I sold 36 of these 22 strike calls at 122, and that worked out to 5.5% weekly time premium. So, and for these 36 calls that I sold, I received $4,356 in cash into my brokerage account after commissions. So if I did that 52 weeks a year, collected a similar premium, you're talking over 200% cash-on-cash return just by selling these calls each week. So when you're collecting that much time premium each week, a lot can go wrong with the trade, and you'd still be profitable. You'd be profitable even if you had bad timing and when you entered the trade, and that's the timing of when you enter is usually not a factor, because with these market neutral spreads, you're on both sides of the market. And the volatile price swings that we have allows me to take profits as early as Monday or Tuesday on these weekly covered calls, market neutral covered calls. So what I like to do is I put an order in as soon as I enter the covered call. I'll put an order in to close out that short call if it reaches 85% of the profit potential, and that way I can exit the short call as early as Monday or Tuesday if we have volatile price swings. And if you're collecting this 2 to 4% per week in time premium, you can be profitable even if the underlying ETF declines in price. You can still be profitable if you're collecting a 200% cash-on-cash return. And here's one of the reasons why these weekly options are so much more lucrative when you're selling premium. Here's a snapshot I took of MasterCard when it was trading at 457, and I took this is a snapshot of the option chain here, and you can see the May 4th weekly option. It only had 4 days to expiration, but you could have gotten, if you sold it at the market and sold it at the bid price, you would have gotten $11.90 in premium. And at the same time, if you had sold the July monthly option, same strike price, 460 strike, which would have been the at the money call with MasterCard trading at 457. So if you sold the July options, which expired in a couple months, you'd collect 23.5 points of premium. So over this same time period, you could have sold 12 of these weekly options at $11.90 and got 142 points of premium versus the 23 points by selling the monthly option. So that's why these weeklies are so lucrative, because in this example, you could collect up to 142 points of premium versus 23 points over the same time period. Here's another example for AIG, and in this example, the weekly, you could sell that at 71 cents, and the monthlies, the August monthlies, you could have sold at 239. So you're going to have 16 of these weeklies, which adds up to over 11 points versus 2.39 points of premium for selling the monthly option over the same time period. So that's why these weeklies are so lucrative. And with these market neutral spreads, because you're positioned on both sides of the market, the market neutral covered calls, they work best when the underlying index is flat for the week. And the losses occur on these market neutral spreads when the underlying index makes a large move in either direction, because remember, you're on both sides here. So a large move either up or down can cause these to lose money. And the best scenario is if the index is just flat for the week. So what I like to do with these market neutral spreads, because you can lose money if the underlying index moves either up or down, I like to sell out of the money calls in puts, and that way the index, the underlying index, can move quite a bit, maybe 6 or 7% before you start losing money. So with these, I found that it's better to sell out of the money calls and give that index some room to move before you start losing money on one side. And what I did is I used historical data to select these out of the money strike prices. So if you use out of the money strikes, you can profit even if the underlying index, even if it rallies or declines 8 to 10% for the week. So that gives you some room with these by selling out of the money options. And for example, if an index on average, if it moves 6% on average per week, then I'll sell an option that is 6%. I'll sell an out of the money option that's out 6% from the price of the index. So this would allow me to profit if the index moves up or down 6% that week. So with this, using this historical data, I'm about 80% accurate on these market neutral spreads. And here's the other part of these market neutral spreads that can make them even more profitable. As I mentioned, if you use a profit target to close out the short call option at 85% of their profit potential, this can increase the accuracy. So let's say you sold a call option at 2 points, and as soon as I enter that covered call, I'd enter a good till canceled closeout trade to close out that 2 point premium, short premium, at 0.30 points, which is about 15% of your entry price. So in other words, you've reached 85% of the profit potential. You might as well just close it out in case that particular ETF comes back. And so if you close it out at 85% of the profit potential, a lot of times, like I say, I'll be able to exit these trades on Monday or Tuesday. And
Chuck, you use that for a parameter just due to the fact that the risk to reward ratio at that extra 15% just isn't there?
Yeah, that's it exactly. You don't want to risk giving that back. So if it gets to 85%, I'm out. And I just have a good till cancel order there. I'll wake up, I'll look at my computer screen and say, oh, I just closed out my short calls today, and it's better to close them out, I found, because like you say, the risk reward just isn't there. So to collect that extra 15% is not worth it in case the underlying ETF comes back, and then you could actually incur a loss on the trade. So I'll just simply enter that GTC order. I wake up, I'm out of the position, and then I wait for the next Thursday or Friday, and then I sell another premium. So here's an example. June 1st through June 8th was the biggest rally of the year, and on average, the market neutral indexes I was trading had rallied 11.4% that week. That was June 1st through June 8th. Now that normally would result in, if it moved up 11.4%, that would have resulted in a loss on the bearish ETFs. But the market had moved down earlier in the week, and I was able to close out the bearish covered calls, and that prevented a loss for the week. And that week, using these profit targets at 85% of profit potential, it gave me 91% accuracy, and it produced $26,000 in net profits after commissions for that week. So normally 11.4% rally would have caused a loss in the short covered calls, but because I had already closed those out earlier in the week, I had a profit on the short ETF covered calls, and I had a profit on the long ETF covered calls. And here's, I think I only had one. Yeah, I had one loss that week. So I had, in this particular account, I had a $16,000 profit after commission, and in this account I had a $10,000 profit, and this was for the June 8th weekly covered calls. And again, the indexes I trade were up over 11%, but I still had a $26,000 profit, and I only had one losing trade because I exited it at that 85% profit target. Here's another snapshot. These are the June 16th weekly options, and I had, in this account, I had a $11,000 profit after commissions. And here's another one. This is the June 22nd weekly options, and I had a $16,000 profit that week. And these are all closed trade profits after commissions that I'm showing you here. So let's look at one more of these spread strategies that's been doing well, the covered calls. And again, with the covered calls, there's a lot more opportunity for success if you trade these weekly covered calls, because you're selling this time premium every week. So just like the super portfolio and the market neutral, the fact that they created these weekly call options back in 2010 dramatically increased your profit potential for these spread trades, because you're selling premium every week. And here's an example. This is a covered call on the small cap ETF, and I bought to close the 46 strike calls, sold to open the 49 strike calls at 147. And I used an option spread order to close out the expiring options, and then to sell to open the new weekly option, and that allows me to save on commissions and also on the bid-ask spread. So at the time I sold these 49 strike calls, the small cap ETF was trading at 48.88. So this was an out of the money call. Sold it at 147, and I collected a total of $2,628 for selling 18 of these 49 strike calls. So again, if you and here's the other thing I wanted to point out. The reason I use the spread order is I just own this the TNA ETF, and I just hold that in my account, and then I roll over each week, each Thursday or Friday. I'll roll over the calls, and I just keep the ETF stock in my account. So I use these rollovers each week. And if you were to initiate a new covered call with the TNA trading at 48.88 minus the 147 you received in the option premium. So if you were trading 100 shares of TNA and you sold this call, you'd have a total investment of $4,741. So this time premium here, of course, is profit at expiration, and because this was all time premium, it was out of the money call, I'll collect $147 in time premium, regardless of the price move of the underlying ETF. And so again, that's time premium you're selling, and if you multiply that out, and you were able to do that 52 times a year, I collect approximately $7,600 in time value profit versus my $4,700 investment. So again, this works out to you have the potential to collect over 160% cash on cash yearly return by selling an option on this TNA each week. So same principle. You can collect a lot of time premium over the course of a year, and when you're collecting that much premium, you can still profit if you have bad timing when you enter the trade, if there's volatile price swings, and even if the underlying stock or the ETF declines substantially. When you're selling 160% cash on cash return, then a lot of things can go wrong, and this trade will still be profitable. So here's a snapshot. A time premium I sold 1 week. This week I sold $16,000. Here's the cash here that was credited to my brokerage account, and here's the options I sold. This week I sold $28,000 in premium, and again, it's listed in the right-hand column here, and that was selling weekly options. So this can really add up over the course of a year. So, and here's an example of rollover trades that I use, because again, I just hold the underlying stock or ETF in my account, and then I'll put an option spread order in to close out the expiring option and to sell to open the new option, and I like to use these spread orders to roll over at expiration. And here's a snapshot of my weekly covered call portfolio. I trade this in 2 accounts, and this had a $332,000 open trade profit, 36% return when I took the snapshot. Here's the second account, and here's a snapshot of last year, March of 2011. I was trading these weekly covered calls, and this snapshot shows in this account I had $323,000 open trades, average return of 54%. So that's a pretty good return for such a low risk strategy. These covered calls, 54%, and this was last year. So I was trading the weekly covered calls last year, and this is a snapshot of my 2009 trading contest, and I placed first that year with an annual return of 122%. And at that time, they didn't have weekly options, but I was trading monthly option covered calls, and I was simply rolling over my covered calls each month, and that allowed me to compound my return. So in this account, I had a 122% return for the year trading covered calls. So, well, that concludes my presentation for today, and I'd be glad to take any questions if anybody has any questions about what we discussed today.
Sure. Chuck, based on people getting involved in covered calls and getting exposure to them, getting their toes wet, what would you say is the bare minimum account size that someone could really start to get active in this type of strategy?
Yeah, I would say with the covered calls, probably a $15,000 account would be well worthwhile. And if you had a $15,000 account, you could probably do 3 covered call trades a week, and that way you could diversify a little bit and collect 3 premiums each week. So I'd say about a $15,000 account.
Okay. I know we have a lot of questions out there. The screenshot that Chuck has up there now is to contact Brad. Brad is he leads his support group, and these guys are pretty good at addressing questions. Many of the questions that we have here today are regarding, how much your services cost and stuff. That's not something that we can address here, but feel free to contact Brad, and he can give you all the ins and outs.